Oh, good morning, Tony Virtue and Partners. And today, great privilege to have a guest here, David Bassanese, who's the Chief Economist of BetaShares.
Good to be with you, Tony.
Well, welcome, David, and thanks for giving up your time.
No worries.
We might start by asking a little bit about your background. How did you get into financial services, and a little bit about your history?
Look, I'm an economist by training. I, did an economics degree, come from Adelaide originally, started at Treasury many years ago.
Right.
Worked overseas, OECD. I started at BT, Bankers Trust, under Chief Economist, you may recall, Chris Caton at the time.
Yes, Chris well.
Look, so I spent years in investment banking as a financial market economist. Then I spent a few years at the Financial Review writing a column on markets. But then I discovered exchange-traded funds on a trip to the United States, and I really thought they had a lot of potential, and I got quite interested in that, and one thing led to another, and ended up, moving from the AFR to BetaShares, who were, a new upstart fund manager in the ETF space.
Well, we certainly can recall all your regular contribution to the AFR. I think that's how people would know you mainly. Perhaps a little bit about your investment style and how do you invest money? Do you invest money?
Yes, I do. Yeah, look, I've had my own self-managed super fund. I'm sure as many investors have for a number of years now. Look, I'm a top-down investor, as you would expect, as a macroeconomist. So, that's why I love exchange-traded funds, because it allows you to, get your asset allocation right. You can invest in equities, bonds, cash, also invest internationally quite easily. So I'm not really a stock picker. I don't go down to that level of detail, but it's more, country, sector, getting the asset allocation right over the cycle. So that's really the way I approach things.
Look, we're just coming through the earnings season. The banks have come out, Australia, as you know, 4 banks between them, 25% of our stock market. How are you reading them at the moment?
Look, obviously they've been under a lot of, basically banks have both cyclical and structural pressures. Cyclically, we know the credit cycle has turned down, the housing market, particularly in Sydney and Melbourne, has turned down, so that the demand for credit, demand for housing loans is coming off. So that's a cyclical headwind they're going to have to live with. The structural one, obviously the Royal Commission having to, they've taken a profit hit, of course, over the past year to fund, make provision for the Royal Commission. Going forward, look, I think they're still pretty strong, as a sector. One thing I don't think will happen is that the so-called fintech sort of snapping at their heels, I think won't make major inroads at the end of the day. I still think they'll remain a very big part of the mortgage market here. They are simplifying their businesses, and that they're jettisoning the wealth management parts of the business. So I think they'll be a leaner, meaner, still fairly strong sector to invest in, still probably likely to generate good dividends over time. Maybe not a lot of good growth the strong growth we've enjoyed over the past few decades from banks is probably past, but I still think they'll be punching out good earnings and good dividends for the foreseeable future.
Yeah, I think you're right there, and obviously we're using those dividends to fund people's retirement, so it's a crucial issue, and obviously it impacts so much on the wider performance of the indexes. They're just so big.
Of course, yes, exactly. Yeah.
Let's have a look at the US. Obviously we had those midterms last night, and always good to see the Dow up 500 points. But how are you reading America at the moment?
Look, I still like the US economy. Obviously it's got very good momentum behind it. It's going to slow down the economy itself. It's been growing at a 3 to 4% pace over the last few quarters on the back of tax cuts, so that's not sustainable. But a slowing to 2 to 2.5% growth next year is still good. The earnings growth outlook is still quite good as well. Valuation-wise, I don't think the market is overvalued given where interest rates are. So, look, I still think the market. I'm not a bear. I don't think we're on the cusp of a bear market. You really need to think the US will tumble into recession within the next year for that to happen, and I don't really see that on the cards. The midterm elections basically stocks rallied overnight because I think what we saw was gridlock is coming back to Washington. So the Democrats have got the House of Reps and the Republicans have the Senate, and it basically means whatever companies have at the moment isn't going to be taken back from be it healthcare companies, be it tech stocks. I think either side of politics is going to find it hard to sort of clamp down on companies through new regulation. I think that was the key takeaway overnight.
Yeah, look, I think you're right, and The extremes, I think, will be limited, and of course, we're all waiting to hear Trump's tax returns. So we'll see what the Democrats do there in some of those committees. Obviously, we have to talk about Australian property. A lot of our clients own property, particularly in Sydney, and we've had a good run for a few years, and perhaps it's just a reversion to the mean. What's your sense at the moment?
Yeah, look, the Sydney property market, property prices are off something like 5% or so from their peak levels, on some measures a little bit more than that. Look, I've been calling the market will eventually correct it. From a valuation point of view, it had become quite stretched if you look at mortgage affordability, these sort of measures. So yeah, I think we're probably midway through that correction. I mean, there's some economists talking about a 20% decline in the price. That's possible, certainly wouldn't rule it out. I'd say more than 10 to 15% when all is said and done, which is still a pretty sizable correction in the market. So that's point one. I think you've got to just, markets will go through these cycles. We've had pretty good strength of property prices. The other question is, what will that mean for mortgage default rates, for banks, for the economy more broadly? Look, I don't think it will lead to an upsurge in default rates. Most households, I think, will wear that like effectively a paper loss. If you're comfortably servicing your mortgage and you're happy in your house and the paper value of your home has gone down, you're not going to be happy, but you're not going to be forced to sell either. And I think that's also the case for most investors at the end of the day. Some at the margins have probably bought in the last year or so. Some may face issues. But it's more an isolated, pockets of difficulty rather than something more generalised. And just as an example, in Perth, they had quite a sizable property cycle and a correction. Default rates did go up a little bit, but not by a lot. So I think that suggests the economy overall should weather the storm pretty well. The other risk for the economy, I guess, will be consumer spending, to the extent that households feeling a little bit not as wealthy. In a sense, and that will probably take the edge off consumer spending next year. So it will lead to sort of challenges for the economy, but I think ones that we'll be able to weather pretty well.
And you'd see very little change in interest rates in Australia in the short term?
Yeah, the short term. Well, I mean, at the end, look, the economy is actually pretty well placed. The economy is going along at an above trend pace, as the Reserve Bank said, reiterated only this week. The unemployment rate's dropped to 5%, so we're seeing good gains in employment across many sectors. And meanwhile, wages growth particularly is still quite low. And there's scope for that to pick up a little bit, and inflation is still quite low. So the Reserve Bank is basically in a situation now saying we can let the economy run a little bit hotter, keep growing without seeing a need to raise interest rates anytime soon. So they're basically on hold, even if the unemployment rate keeps dropping, until such time as we see a decent pickup in wages growth, which if you're looking around the world, you're not seeing much evidence of that in even countries that have tighter labour markets than in Australia. So I think there's a ways to go before that will become an issue and force the RBA's hand. So certainly at least till the second half of 2019, and some economists are talking even further than that. But I'd say for the foreseeable future, my base case is rates are going to stay pretty much where they are.
I think clients will be happy to hear that. Now, David, you're going to be joining us at our Christmas function. We're very much looking forward to seeing you there. Perhaps we could just finish our interview with a little bit about BetaShares. It's a growth area. We've exchange traded funds, possibly not particularly well understood in our community. Could you just give a quick flavour as to how this all works?
Well, yeah, an exchange-traded fund really, first and foremost, it's just another managed fund. So the typical type of managed funds most investors are familiar with, diversified exposure to a collection of shares or bonds run by a manager. The only difference is they're available on the ASX, so they're exchange-traded, so you can buy and sell them on the ASX. And the other difference, without getting too technical, is compared to, say, listed investment companies, which are also available on the ASX, these are designed to trade near their net asset value. So if the underlying value of shares that an ETF would own goes up by, say, 10% over a period of months, you can be pretty sure the buy and sell price of that ETF will reflect that. So that's the key. It's a key structural difference. Now, a lot of them are index tracking, so passively managed, so that's another feature. If you want low-cost passive exposure to different markets, ETFs will provide that. But there are now a bunch of ETFs that are actively managed as well. But the key issue is that, again, compared to LICs, is that they're designed to trade near their NAV over time. So we think that's an appealing feature for investors.
I mean, one of the things I know our clients like is that even if it's a small amount of money, $5,000, $10,000, you can get access to, basically the best in the world.
Yes.
And that's a wonderful opportunity at a very, very reasonable fee as well. So.
Yeah, I mean, the world is your oyster now. You're on the ASX with exchange-traded funds. You can buy tech, Asian stocks, US stocks, tech-focused stocks like the Nasdaq, for example. Low cost, very low cost exposure. Also, different income funds. And if you want fixed income type products, bonds, even hybrids, there's different funds giving you exposure to all different asset classes. And I said, not only in Australia but also international markets. So again, as a macroeconomist, I do like that because it allows you to look at things from a top-down sector point of view.
Well, thanks for that, David, and we look forward to seeing you at our Christmas function.
No worries. Thanks a lot, Tony.
Take care.